the promise. By the end of this video, we'll understand how all markets are influenced by powerful players so that we can finally play the game the right way and gain a competitive edge in our trading. But before we do this, I'd like to first set the right mindset. Only when the mind is empty and receptive, like that of a child, can true understanding take place. And what I mean by that is, whenever we approach learning with prior judgment, prior system of beliefs, or even with comparison, all that does is block our understanding. All it creates is internal conflict because we're constantly comparing what we already know with the information that we're getting. And we're too busy justifying our current system of information instead of taking the time to actually understand and absorb the new information that is coming our way. So to make this whole learning process easier for us, I invite you to not resist to this new knowledge. So in other words, I invite you to do the following things. I invite you to receive information like a sponge. So no prejudices and no filters from prior beliefs. I also invite you to then avoid comparing what you're learning here with what you already know. Because once again, comparison is the thing that creates that internal conflict and that blocks your understanding. In other words, let yourself be surprised. That's because true learning happens when we open ourselves with humility. Again, it's exactly like a child discovering the world. And for some reason, adults often want to prove that they're right. But on the other hand, children, they just want to understand the world. So let's give up being right, because our goal is to understand. Our goal is not to prove that we are Mr. Know-it-all or Mrs. Know-it-all. So let's adopt the mental posture of a child, because that's going to allow us to detach from the ego, absorb the foundational principles without resistance, and truly embrace this valuable information. So let's do this. So this whole journey is all about VPA. But what exactly is VPA? VPA stands for Volume Price Analysis. The V for volume, the P for price, and you analyze them together, and that's where you get the word analysis. So it's volume price analysis. And in essence, it's a way to make trading decisions by always looking at the relationship between two things and only two things. Those two things being volume and price. But what does this actually mean for us? The chart that you have in front right now is the chart that most traders use, because most people trade only looking at these vertical bars that are in the middle of the chart. And this is the so-called price action or the price movement of a specific instrument. The instrument being here, micro gold futures. What a price chart tells you is the price of the specific instrument at a given time. So for example, at the beginning of April, the price of gold was around 3,200 USD. This is for the micro gold futures. But it also shows you how the price has evolved. For example, now in July, the price is around 3,346 USD. So it tells you what is the price right now and how has the price moved compared to the past. And the traders that use only looking at this price movement or only looking at the price action is what we call price action traders. Traders that trade only looking at the price action. But we're not here to trade only looking at the price action. We're here to look at the price action and add something to our analysis, which would be volume. And therefore the charts for us would look like this. You have the same chart, but you have the vertical bars at the bottom. And the vertical bars at the bottom is what represents volume. Volume fundamentally tells you how many transactions have taken place. Whenever a share goes from person A to person B, that would count as one transaction. So that would count as volume equals 1. So in essence, volume is the number of times that a thing switches from one owner to another owner. Some people call it the trading activity. Other people like to refer to it as the number of transactions that have taken place. Other people like to explain volume as every single time that a share switches ownership, like it goes from the pair of hands of one person to the hands of another person, which then basically means that the more times a thing changes ownership, the higher the volume is going to be, and therefore the higher the volume bar. For example, notice this extremely high volume bar here around the end of April. This means that there was a lot of ownership switching. So there were a lot of shares going from person A to person B, aka there was lots of trading activity, and that is reflected in this very high volume bars. So VPA is looking at these two things in conjunction. You're looking not only at the price, you're looking not only at the volume, but you're looking at the price and volume together. You're looking at the relationship, like they're continuously dating and you're analyzing the relationship that they're in. So in essence, it's tracking two things at once. And a very good analogy to explain why we would need to track two things at once is, for example, when you're driving your car. This is the analogy in which it really reading the speedometer, but at the same time you're listening to the sound that your engine is making. Only by reading the speedometer, it's not enough to know if you're actually driving the car properly. Because yeah, the speedometer can say one thing, but if you hear the engine overworking, then you know that the car is not cruising smoothly. So in order to drive smoothly, you have to do two things. You have to look at the speedometer, but at the same time you have to listen to the engine. It's the same thing with trading. Instead of only looking at the price, which would equal only looking at the speedometer, you'll look at volume to know what's happening behind the scenes, aka you're also listening to the engine. And when you combine both is when you get the smoothest drive. And that's exactly what we're gonna learn. So here's the premise of VPA. It's important to know the premise of VPA because it's gonna explain the why behind the strategy. Because if there's no why, then there's no conviction behind your decision. So before you actually choose to go with VPA, it's important to understand, okay, why am I making this decision? So VPA is based on 5 premises, and we're gonna go through each 5 of them. And the first one being, the markets are manipulated by the big dogs in one way or another. Second, the big dogs buy and sell not in small quantities, but in massive quantities. Third, big dogs have a special skill. It's what I like to call kind of a magic trick because they can create chart illusions. But we're gonna understand this later down the road. Fourth, big dogs have one thing that they cannot hide, and that one thing would be volume. Which brings us to the 5th point, and that is, if we know that the markets are manipulated by the big dogs, then that means that to be on the right side of the game, we have to follow the big dogs. We have to buy when they buy, which means that we have to sell when they sell. Sounds easy, right? We're gonna cover one by one, and we're gonna make sure that you understand these points because these points are fundamental for the next chapters. So I kindly invite you to take the time and take the effort to really understand these foundations because it's really gonna pay off. It's gonna make it much easier for you. Let's look at the first premise. But the first question is, who are these big dogs? Is it a person? Is it a group of people? Is it an institution? In essence, big dogs are players with lots of money that, because of the amount of money that they have, they become powerful. So in essence, it's people or groups of people that have so much money that as a consequence, they have the ability to buy and sell in massive quantities. Which means that whenever they buy shares, they don't buy 1 shares or 2 shares. They buy thousands of them, and therefore they create a huge imbalance between supply and demand, and therefore the price goes up. So the big dogs have the ability to significantly influence the price up when they buy, which means that the reverse is also true. They have so many shares in their hands that they can sell in massive quantities, and when they sell in massive quantities, they're able to create a significant imbalance between supply and demand, and as a consequence, the price drops. All in all, it's players that they have so much money at their disposal that they can move big. They can truly influence the imbalance or the balance between supply and demand, and therefore they can influence the price that you see on the chart, and that's where they get the power from. Examples of big dogs are, for example, big banks and investment banks like JP Morgan. It's basically huge financial companies that whenever they buy currencies, any other assets, they do it in massive quantities. Then you have the central banks, which are basically governmental organizations that control the money and the interest rates, and it's the exact same game. They don't buy and sell in small quantities. They do it in large quantities, and therefore they can be spotted through high volume. When the big dogs move, they move big. Then you have hedge funds, which are basically groups that use other people's money to bet on the market predictions. And the same thing, they buy and sell not in small quantities, but in huge quantities. Then you have market makers, which are companies that set the prices at the exchanges so other traders can trade. And again, same game, massive quantities of buying and selling. Then you have the high frequency traders, which are essentially fast computers that can buy and sell extremely quick. Once again, massive quantities, so buying and selling in big. And then you have major corporations, which are big companies that are moving money to make their own deals. And again, they're not moving small amounts of money. We're not talking just about a few shares. We're talking about thousands of shares. And therefore, their activity can be reflected in volume. So in essence, a big dog is any player that has so much money at their disposal that they can buy and sell in massive quantities. Therefore, you have a bunch of shares that are switching ownership from the big dog to another person or from a person to a big dog, and therefore it's reflected in high volume. But what does it exactly mean when people say that the big dogs manipulate the market? But in order to analyze this, we first have to make sure that we analyze the story from the big dogs perspective. If you think about it, the big dogs, aka they also go by the name of the insiders because they have inside information, they want to do one thing, and that is they want to make money. I mean, we all play the game not to lose money. We play the game to make money. And the only way to make money is by buying low and selling high. There's no other way around it. And that's exactly exactly what the big dogs want to do. They are designed to make sure that they buy low so they can sell high later on. Which means that if the big dogs want to buy low, that means that when the big dogs are buying low, there must be someone on the other side of the story that is selling low to the big dogs, right? Because otherwise, who would the big dogs be buying from? Which also means that when we're at the top and the prices are high and the big dogs want to sell, there means that there's somebody buying at a high prices from the big dogs, right? Otherwise, the big dogs, who are they selling to basically? Which means that there is a constant dynamic between two parties. On the one hand, you have the big dogs, and on the other hand, you have the retail traders, aka the big dogs and the regular blokes that do not know how the markets work, aka the smart money. The big dogs also go by the name of smart money, and the retail traders or the regular blokes also go by the name of emotional traders. And then, of course, the insiders, big dogs, insiders, same name, versus the peasants. The peasants just refers to the uneducated trader. So whenever the big dogs are buying, they're buying from the peasant that is selling. And whenever the big dogs are selling, they're selling to the peasant that is buying. So the dynamic looks like this. You have the big dogs, they're buying from the selling peasants. Big dog is buying from who? The peasant that is selling the shirt to the big dog. Which means that the big dogs are selling to, you guessed it, to the peasants. So there's always a constant dynamic between these two parties. You can call it the insider versus the uneducated trader, or the market maker versus the regular bloke, or the big dogs versus the peasants. Whatever concept works for you. The important thing is to understand that it's a game played between two people. One that controls the game and the other one that follows the signals that are produced by these big dogs, by the insiders. The big dogs need the peasants because when the big dogs need to buy low, they need the peasants to sell low. And when the big dogs are selling high, they need the peasants to buy high. So big dogs only make money because there's a peasant. There's an uneducated trader on the other side of the story. Just to be clear, why we call them peasants, the reason is very simple. I watch a lot of Luke Belmar, and he refers to the uneducated person or the financially illiterate person as the peasant. And he's referring to the historical concept where you had the king, he had his kingdom, and then he had the peasants that were working for the king. And historically, the peasant was the person that couldn't read. He was illiterate, not even financially illiterate, but they couldn't read at all. We refer to the peasant as the uneducated trader just to conceptualize this. So the dynamic between the big dogs and the peasants is very simple. The big dogs buy at the bottom, they buy cheap, which means that at the bottom there is somebody that is selling. The peasants sell at the bottom. And the big dogs, they make money by selling high, they sell at the top, which means that at the top the big dogs are selling to somebody, the peasant that is buying at the top. Notice that the big dogs are buying low and selling high, and that's the only way you make money. But on the other hand, if the peasant is doing the opposite of what the big dog is doing, they're buying high and selling low, then that means they're losing money. So the question is, why in heaven would a peasant do that? Let's see how that works. Before we do that, I want to make an important note. Big dogs have access to information before it's made to the public. Before any news gets released, the big dogs have already made their move. Let's say that the big dogs, they want to release some news about maybe a virus, a deadly virus, which we know that it's going to create a lot of fear, it's going to create a lot of panic, like we saw what happened during the pandemic, that like the stock market crashed. So before they release the news, so before the stock market crashes, the big dogs are already selling because they know they're going to release the negative news and they know the market is going to crash. So the big dogs sell and then they release the news. So it's the big dogs that are ahead of every single event that you see in the news and on your social media newsfeed. So know that the big dogs move based on information that the rest of the public doesn't have. And the second is that peasants use public information as their main source of information. It's referring to the people that watch the news to make their trading decisions and the news only, or they rely only on tweets, which doesn't mean that you cannot be successful with that. Probably you can be successful with that. But the way that the game works is that by the time that any news gets released, it's all orchestrated by the big dogs. So keep that in mind. But now let's try to understand why the peasants would actually buy high and sell low. Let's start with a situation in which the market is trending at high prices. And the big dogs, they want to buy, but they're not stupid enough to buy at these high prices. So the first thing that the big dogs need to do is they need to make sure that the price goes all the way down so that the big dogs can then buy somewhere low here. But what could trigger the price to go down? Think, for example, what happened during COVID, all the fear that was going on. Or maybe the stock market crash from the 30s. Maybe fear and panic selling would be a good way to create a market crash. The only thing that the big dogs know is they have to create fear and panic among the peasants to make the peasants do what? Panic sell. And the big dogs have many different ways to create panic. For example, they use bad economic reports, or they use scary headlines about war or a disaster or maybe a deadly virus. Anything that has a gloomy prediction. And they spread this through news channels, through social media, or even using big influencers, or maybe even a politician that's throwing a tweet. All we have to know is that the big dogs are so powerful, like they own the narrative. Like you really think that they don't own the news channels that you watch? You really don't think that the news channels are all synchronized, that they don't influence the algorithm, that what you get to see on your social media is not carefully crafted?
Sharing of biased and false
news has become all too common on social media.
More alarming, some media outlets publish things they aren't true without checking facts first.
Unfortunately, some members of the media use their platforms to push their own personal bias and agenda to control exactly what people think. And this is extremely dangerous to our democracy.
And I'm not conspiracy theories. This is something that you need to verify yourself. Like, don't believe anything I say. Go ahead and verify it and see it for yourself. But going back to the story, you have the big dogs that are generating all this panic through this negative news. And the consequence of that is that the peasants see the bad news on TV. All they see on TV is about war. Everybody is dying from a virus. Stay home. It's the end of the world. So people actually get scared and people actually panic. And that's what creates the panic selling. This is what generates the price going down. You have the peasant panic selling. And again, this is all carefully orchestrated by the big dogs so they can buy low. So on the way down, the peasants are panic selling because the peasants, all they see is the news. But then at some point, the market reaches a bottom. But even at the bottom, some peasants are still panic selling. So even when the price went all the way down, there are some peasants that are thinking, wow, I'm still seeing so many negative news. The price is going to keep crashing. Like this is just going to get worse and worse and worse, and everybody around me is telling me to be careful, to stay home. Panic, fear, I'm gonna sell. I'm gonna get rid of the shares because I predict that everything is just gonna crash. So once the bottom is reached, the peasants panic sold. So the peasants were panic selling on the way down. And some continue to even panic sell everything they have at the bottom. And remember the constant dynamic between the big dogs and the peasants. While the peasants are panic selling, the big dogs are buying at those cheaper prices. So the big dogs buy from the peasants at the lower prices. And the markets tend to go sideways while it reaches the bottom. And in later chapters, we're going to understand what happens exactly when the markets go sideways and when they go sideways. But the most important thing to understand now is the markets go down and then it goes sideways. And during that part of the market cycle, the peasants are panic selling. And even when the market goes sideways, some peasants are still panic selling. All the while, the big dogs are buying at cheaper and cheaper and cheaper and cheaper prices. So more peasants are panic selling here when the market goes sideways, and the big dogs are buying cheap. Which means that the narrative on this specific part of the market cycle is a negative narrative. Remember, the fear, the panic, the news, the war, the bombs. And because there's so much panic among the peasants, they're gonna panic sell, and the big dogs are buying in massive quantities and they're buying at cheap prices. So this is the dynamic that is going on this part of the market cycle. But at some point, the peasants have panic sold everything, which means that the big dogs cannot buy more because the peasants have sold everything they wanted to panic sell. At some point, the big dogs, they have their hands full and they're like, okay, great, now we're gonna sell what we have. But we're not so stupid to sell at these low prices. We first have to make the price go all the way up, and then we're gonna sell high so we can maximize the profits. So we are here when the markets were going horizontally at the bottom. And this is what the big dogs now need to create. Because remember, the big dogs bought at a low price and they have to sell somewhere at a higher price. While the big dogs used fear to make the peasants panic sell on the way down, now the big dogs are gonna use the opposite to make the price go all the way up. Which means that the big dogs create excitement and optimism among the peasants. Instead of using bad economic reports, the big dogs use good economic reports. Instead of using negative and doom scenario headlines about war, they now focus on the headlines about peace or stability, and you have many optimistic predictions. And again, this is all spread out throughout the exact same news outlets, throughout the exact same social media platforms, and using the same big influencers. It's the same methods, but in reverse. The consequence of this positive marketing campaign is that the peasants, still watching TV, suddenly they hear a lot of positive news, like everything is looking perfect, everything is gonna go to the moon. They feel excited and confident, and the peasants then buy out of fear of missing out on a golden opportunity. This type of buying is what we call buying out of fear of missing out, aka FOMO buying. Fear of missing out buying. As the price is going up, the peasants are FOMO buying because the peasants are seeing many positive news on TV and they think that everything is gonna go to the moon. We're back to the roaring 20s basically. When the price is going up, the peasant is thinking, God damn, I don't want to miss out on this golden opportunity. Like, look at how much the price has increased. I want to make some quick profits. I need to play the game because look at how much the price has gone up. I need to get in the game right now. But the thing is, most of the peasants have something special, and that is they don't normally buy right at this level. They actually buy pretty much last minute, pretty much at the end of the trend, at the end of the ride higher. But why is that? This is where the peasants normally buy out of fear of missing out. So this is where the peasants normally buy out of fear of missing out. And again, to understand this, we have to see it from the peasant perspective, because remember that the peasant comes from fear, from panic, from the doom scenarios. And we know that in human psychology, it's very easy to break the trust and very difficult to regain the trust. So the peasants are scarred, they're hurt, they're very doubtful to play the game once more. In the peasants' mind, they're like, I see the prices going up, but you know, I'm skeptical because I pretty much lost all the money that I had in the previous half of the market cycle. You know, first I need some proof that the price is actually going to go up. And so the peasant is thinking, I need to see the price go up even more so that it serves as a verification or as a proof to myself that indeed what I see on the news, all the positive things, is actually true, which is at around this green dot that we see over here. But by then, it's the end of the ride. So either the peasants that enter here, they're gonna make very small profits because they buy at this green dot and then they sell at the top, which the top is very near, or there are even some peasants that buy at the very top. And speaking of the top, once the top is reached, peasants excitedly keep FOMO buying everything they can. So we saw that on the way up, you have the positive news and some peasants are like, I don't want to miss on this golden opportunity, I'm gonna buy. But even while the market reached the top, there are still other peasants that are FOMO buying all the way here. And remember, go back to that initial dynamic between big dogs and peasants, that when the peasants are FOMO buying, that means that somebody is selling to the peasants, which would be the big dogs. So the big dogs are selling high. So even at the top, you have more peasants that are FOMO buying and the big dogs that are selling high. Also, at the top, the markets tend to go sideways. And one more time, later on, we're going to understand why the markets go sideways at the top and what is actually happening inside of this area of the market cycle. So on this second half of the narrative, you have, instead of a negative narrative, you have a positive narrative where the peasant is buying out of fear of missing out and the big dogs is selling to the peasant that is buying. And the big dogs is selling also in massive quantities and at a high price. And remember that the big dogs bought at a low price. Now the big dogs are selling high and the peasant is doing the exact opposite. So the big dogs are making money and the peasants are losing money. But as you can imagine, while at the top, at some point, the peasants that are FOMO buying everything, at some point they're done FOMO buying all they want to buy, which means that the big dogs are done selling everything they could, because if the peasants don't want to buy, that means that the big dogs cannot sell. So the big dogs are pretty much empty-handed and the big dogs are like, okay, so we need to buy again, but they're not stupid enough to buy at a high price. So what do the big dogs need to do first? They need to make the price go all the way back down. And how do the big dogs do that? You guessed it, with a negative narrative. Come again, the fear, the war, and the cycle repeats itself. So the whole cycle looks something like this. Remember that we started when the price was high, and the big dogs are not stupid enough to buy at these high prices. So the first thing they need to do is they need to make sure that the market goes down. And the way that the big dogs do that is through the negative news narrative. War, explosions, bombs, terrorism, you name it. And this generates the so-called peasant panic selling. And while the peasants are panic selling, remember the constant dynamic, the big dogs are buying at cheaper and cheaper and cheaper and cheaper and cheaper prices. Till at some point, the market goes sideways. And even when the market goes sideways, so even when the market will reach this bottom, there's the final peasant panic selling, you know, the last set of peasants that still haven't panic sold. So the big dogs still have the less chances to buy at the cheapest prices. Once the big dogs have their hands full, they need to sell. But the big dogs are not going to sell at the cheaper prices. So they first need to make the price increase. This is what the big dogs need to generate. And the way that the big dogs do this is through positive news narrative, peace, stability. And the consequence of this is that the peasants start buying out of fear of missing out on the golden opportunity that are sold to the peasants on TV through the news. And while the peasants are FOMO buying, again, going back to that original dynamic, the big dogs are selling. The big dogs are selling at higher prices and higher prices and selling at higher prices until we reach the top again. And at the very top, the peasants do their final FOMO buying. So the peasants that probably didn't enter the game here, they're gonna buy somewhere here, but still out of fear of missing out. And going back to that dynamic, while the peasants are FOMO buying, that means that there's somebody selling high, which would be the big dogs. The big dogs are selling high. And once the big dogs have sold everything high, they need to buy again. But of course, they're not gonna buy at high prices. So they need to bring the price all the way back down. And we're back to square one. So this is how the markets are influenced by the big dogs. So it's not that the big dogs influence the prices per se. It's that the big dogs, they control the narrative. They implement a marketing campaign, and with that marketing campaign, the narrative, they're able to generate a certain emotion among the peasants, which could be panic or could be greed, optimism. Everything is looking good. And it's that emotion that makes the peasant either panic sell, emotional trading, panic is an emotion, or FOMO buy, buying out of fear of missing out, which fear is also an emotion. All in all, what the big dogs are doing is they're using many tools at their disposal that they control, because the big dogs control the narrative, to influence the emotion of the peasant. And if the peasant isn't informed, the peasant is going to react emotionally and be on the wrong side of the trade. And it's the circle of life. Markets rise and fall repeatedly with patterns that keep looping over and over and over again. And what volume price analysis does for us is, instead of being on the peasant side, so instead of trading emotionally, instead of only relying on the news, we get to look at volume. We get to see at when are the big dogs making their moves. When are they buying? They buy in high quantities. When are they selling? They sell in high quantities. And when are they not participating? When the big dogs buy, we buy. When the big dogs sell, we sell. And when the big dogs are not participating, we wait until further signal, because the big dogs know where they're taking the market next. And this is the power of volume price analysis. Volume allows you to spot when the big dogs are involved and when not. So you know when to involve yourself in the game and when to stay on the sidelines. Pretty powerful, huh? So we saw the first premise that all markets are manipulated by the big dogs. And on the next chapters, we're going to analyze the 4 points. And after we do that, we're going to have a solid foundation of how the markets work. And as I said, once seen, never unseen. See you in the next one.